Hey traders, we're all getting ready for the FOMC tomorrow, and we're preparing for what will be expectedly, right? Some clarity on whether or not the Federal Reserve could cut in March or whether we just start to see May and June the beginning of this dovish pivot, this dovish cycle that we're embarking on this year. It's coming. We just don't know when or at what pace. But we do know this very busy looking chart, I get it, I'm going to decode it for you right now, is the first step in how I'm going to prepare for the Federal Reserve. So first of all, the only uptrend that we have right now is the S&P. Russell's in a sideways momentum, sideways trend. Dow is bullish momentum, sideways trend. NASDAQ is bullish momentum, sideways trend. Okay, well, we have the Magnificent Seven earnings this week, as if there isn't enough going on this week. 5 out of those 7 report this week. So let's put the NAS aside. Our best edge is coming from the S&P, and the first question we might ask is, well, why is that? And it's really simple. If we take a look at XLK plus XLF equals S&P, and this is because when the tech and financial sectors are moving together, they disproportionately benefit the S&P, hence green, green, and green, right? So that's the structure that we want to take advantage of. And if we want to be even more specific, and this is something that I've been doing in the Sector Secrets Mastery, and that's focusing on long positions within the XLF, long positions in 3 places: JP Morgan, Bank of America, and most recently American Express. So these are all top 15, top 12 names in the financial sector. Rising tide in the S&P, rising tide in the XLF sector, that's going to take those individual boats with it. Now you might say, well, Rog, how does that prepare us for the Federal Reserve? Any pullbacks in the S&P, communication sector, tech, semiconductor, and financials would be great, but do I really want to engage tech, communications, or semis when I know, again, 5 out of the 7, Magnificent 7, are releasing this week? No, that's where it's kind of easy to hide out in the XLF. But that's not the only thing going on. Let's pivot to another decision-making time frame that we can take advantage of with the Federal Reserve, and that's the 1 hour. And I'm going to get into the 1 hour bond, gold, and dollar, but I'm going to show you a different way to do it. All right, so first of all, we had the JOLTS come out today, and the initial reaction on JOLTS was, well, a pretty big sell-off, and that was yields rising as the JOLTS sent bonds lower. But ultimately, you can see they've really recovered quite a bit, and this continues to indicate that even bonds are saying, look, we're in the bullish hemisphere. We're above the 200 exponential. We're expecting the dovish pivot. We're just not sure when, hence this very wayward action. It still makes sense to focus on long positions in the daily price movement range. And if we can get that particular bit of volatility down to the gray area, that's support from the standpoint of historical volatility, I will be a buyer. Another place that I'm a buyer already with an open position is gold. There's really 3 very cool ways to trade gold, whether you're a futures trader, whether you're a ETF trader, or if you want a smaller futures contract. Micro gold, full-size gold, GC, that's on my screen here, or GLD options, right? Calls and GLD. So calls and GLD have been working great. The whole idea with buying GLD is, if I want to buy gold, but I don't either want to deal with the initial margin requirement nor the leverage, what are other choices? Well, micro is one way to do it. Or in the case of looking with gold and GLD together, what we did is, for overnight trades where traders want to be able to scale in with a pretty reasonable amount of exposure but not have the leverage and initial margin requirement, we bought 16 February 185 GLD calls. And we did that at 186.80, which is this blue line right here. So this was our entry trigger for the GLD calls. And you can see where we are now. And this is already a trade that we can scale out of. We have scaled out of it at 188.50. But the cool thing is now I've got a smaller position, less exposure. That actually does equate to some degree of less risk. And I can take this into tomorrow's FOMC, maybe at least to noon or 2 p.m. Eastern, or even past that. So we want to stick bullish with gold. If we get sent all the way back down to the gray zone of the daily price movement range, we'll look to enter that trade all over again. Now, the last thing I'm going to show you is how I look at the dollar, right? Now, so far, bonds are indicating yields generally are not heading higher anymore. Bonds are choppy, trying to move higher. That's lower yields. That's definitely reflecting a dovish pivot. Gold is moving with bonds. Gold reacts to real yields or real interest rates. Gold moving with bonds, also indicative of the same narrative. This is the 6E. The 6E is the absolute best way, whether it's the 1 hour or the daily. It's the best way to understand what's happening with the US dollar. Don't worry about the US dollar basket. That's 6 currencies. This is the main relationship the dollar has in the currency universe, and that's the euro versus US dollar represented by 6E futures. This is where we want to ask ourselves, is the dollar at a point where if the euro moves lower past the 200, that's actually strength in the US dollar. If the euro can launch higher off this area, this 200, that's bearish for the US dollar. So it's an inverse or negative correlation. Very interesting as we go into this January meeting, where it's less about any shift in the rates and more about what expectations are about it. We're sitting right at really a decision level. So keep an eye on this area around 108.50, 108.60. Are we going to move higher off this level or lower off this level on the Federal Reserve? That's going to show us the next leg of the US dollars. This is how we're preparing for the Federal Reserve, trading around tech, which is its own chaos, its own mosh pit this week, focusing on financials, which continues to produce, and then looking at euro, bonds, and gold for signs about really believing in this dovish pivot, either in March or May, and how we can trade these symbols. Let's look long bonds, long gold, and ultimately I want to be long euro, but this is the one I like the least. All right, that's how we're preparing. I'll see you in the next update. And by the way, in the premium video, I'll be diving into levels, triggers on these symbols, and a whole lot more. So check it out in the premium video. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.